Good afternoon, good morning. Hope you're having also a good lunch because it's 1 o'clock in Florence. My name is Nicola Bilotta, and I'm a senior research associate here at the Florence School of Banking and Finance, and I will be chairing today's online webinar titled Unstable Coins, Regulatory Challenges and Global Implications. When Pierre and Thorsten launched the idea of organizing this webinar, fun enough, a few days earlier, I was speaking with Maria on exactly the same topic. So I think we are touching base on a very relevant and significant policy discussion that is interesting many people around Europe and the world. And I cannot think any other speakers more relevant in the room than the three colleagues that are going to be speaking today with us, starting with Maria Demertzis, who is the leader of the ESF at the Conference Board Europe, as well as part-time professor at the School of Transnational Governance at the European University Institute. Richard Post, professor of the London Business School, and is also the co-chair of the ESRB Crypto Asset Task Force that came out with a super interesting report on stablecoin, crypto investment product, and multifunctional groups in October 2025, which touch base on many of the issues that we are going to talk about today. And last but not least, and not only because it's my boss, Thorsten Beck, who is the director of the Florence School of Banking and Finance and professor of financial stability at the UI, and is also co-chair of the Advisory Strategic Committee at the ESRB. So before starting going into, let's say, the more technical discussion, my first question would be for Thorsten. Just to set the stage, could you briefly explain what stablecoins are, how they function, and why they have become such a central issue in the European and global financial debate? Thorsten, you have 5-6 minutes to give us some very initial remarks. Thank you.
Thank you very much. I'm not even sure I need all of this time, but welcome everybody. Yes, so stablecoins are on the one hand part of the crypto world. So there are crypto assets, privately issued tokens operating on public blockchains. But unlike other cryptocurrencies, I mean, Bitcoin being the most prominent and oldest one, they aim to maintain a fixed value, a stable value vis-a-vis some other assets or a basket thereof. And again, asset can be anything. It could be gold. You could have a stable coin linked to tied to the gold price. It could also be a basket of currencies, for example. But most stable coins are or aim to be pegged to the US dollar. So one stable coin US dollar for one fiat US dollar. Now, when I say aim to, it is not, it is what they try to do. And also it should be reflected in the balance sheets of stable coins or of companies that offer these stable coins. On the other hand, we've seen that the standard deviation, the volatility in terms of the value, the price of these stablecoins vis-a-vis the assets they are supposedly pegged to is not zero. So there is volatility, meaning that's why I guess we also have the title. It is not necessarily stable. There can be sometimes very unstable coins. And that's exactly one of the issues that I guess we're also going to come back to during the discussion today. So they are, again, unlike money, unlike fiat money, they're not backed by they're not legal tender, they're not backed by a sovereign. They are privately issued in the crypto world. Now, ultimately, this all goes back a couple of years ago, and I have to admit, I don't quite remember exactly which year, when Facebook / Meta first proposed Libra, and then later it was renamed Diem, a project to basically issue a stablecoin. Back then, this was really received with lots of opposition. by central banks, by regulators, including, of course, the ECB, the Federal Reserve, and Bank of England, and so on. Things have changed, and I think we're going to come back to this in just a moment. I guess the main concern is that this would be some kind of competition for legal tender. So it would kind of undermine monetary sovereignty. It would undermine the monetary policy transmission. And of course, if stablecoins are in a certain currency or tied to a certain currency, then this would actually also undermine the global role of certain currencies, such as the euro, for example. So now when Libra and Diem discussion, the reaction of some of the central banks, including the ECB, was, well, we can't really stay behind in this kind of digital arms race, if I'm going to call it like this. And that was also behind the push ultimately for more CBDCs, including the digital euro. Now, this kind of has somewhat a bit unlinked these two discussions, but it is still there. Because again, the idea of stablecoins is for payment purposes, especially for cross-border payments. Now, in Europe, you could argue, why do we need stablecoins for cross-border payments, at least within the euro area or even within the EU? It is a reasonably efficient, it is certainly a very quick payment system. Although, of course, there might be hidden costs that comes to us through the account fees with deposits. It's outside the banking system, so one could say, well, maybe it's actually good that the banks get a little bit of competition when it comes to payment services. However, having said this, and actually that's also what Richard showed in the report that he co-authored, is that stablecoins are not really used for standard cross-border payments, but they're mostly used as an on-off ramp to other cryptocurrency. So really being the bridge between the traditional financial system and the decentralized financial system, the DeFi. This is what most of them are being used for. Now, why is it now suddenly becoming an issue? Because the US is strongly pushing for stablecoins, both by adopting a new regulatory framework, the so-called Genius Act, but also just politically, there's a lot of kind of mildly said goodwill, if not outright pressure, to have more of these stablecoins around. I guess partly I would see it as an attempt to kind of strengthen the global dominance of the US dollar, because if most of the stablecoins are tied to the US dollar, then of course this would also imply more inflows into these stablecoins in terms of reserve holdings in the banking system, treasury bills, and so on. Ultimately, this would kind of offset part of the other policies by the Trump administration, who really intentionally, unintentionally, really undermine the global role of a US dollar. So, but this is kind of the I guess the political background to that, and of course what we then see also happening in the markets, and of course, and we're going to come to this in a moment, the difference between the regulatory frameworks in the EU and in the US in terms of how to regulate these stablecoins. Let me stop here.
Fantastic, Thorsten. Thank you very much. I think you also already whet our appetites on many of the topics that we are going to touch base later. And it was summer 2019 when Libra was announced, because I remember I was to present an edited volume on big tech finance a few days after. Then I took the book and say, this is already old after 1 year of work, but this is another story. So going back to Richard. So Richard, as Thorsten was mentioning, stable coins have become again a very key issue in our financial debate, following the, let's say, proactive stance of the US administration. So my question for you would be to provide an overview, let's say, on how the European Union and US policymakers differences in their approaches to regulating stable coins. Do you see this regulatory path converging or diverging? And the key question is also, can national regulations properly frame stablecoin?
Well, let's start from the fact that the crypto lobby in the United States is very well funded. Crypto issuing, stablecoin issuing in particular, is a very profitable business. You take people's money, you give them this token, you can invest their money, you don't pay them any interest. Isn't that nice? and you can make that money with very low overheads. So the crypto lobby has been very well financed, and they gave a lot of money in the 2024 U.S. elections. That's the first thing to bear in mind, keep in mind, because it's operating over here too, and in particular, Circle is operating very extensively in Europe. The Trump family, of course, has also made a lot of money out of crypto so far. They're very much involved, and Trump has appointed in the various regulatory agencies a whole flock of very crypto-friendly regulators. So that's the environment in the United States. And that part of that environment was the congressional scene, where many congressmen, senators received donations, substantial donations from crypto in their election campaigns last autumn. And indeed, they went ahead and legislated. So you have already the Genius Act passed in July, which gives a basis in particular for stablecoins. And that basis is somewhat different from the European Union regulation, MiCAR, the Markets in Crypto Assets Regulation, which went into force in 2024 already. The differences are not huge, but they're significant. In particular, in the Genius Act, there's no ban on redemption fees. So the issuer can charge a redemption fee. The issuer can't, on the other hand, offer yield on the stable coin. As I was saying, actually, that's rather profitable. They can't offer yield. On the other hand, organizations, crypto asset service providers, what we call multifunction groups in our report, can indeed offer yield. They can take stable coins and offer yield to the owners. So that is a possibility open to the holders of stablecoins in the United States. The issuers too in the U.S. can, under Genius, can engage in risky activities. They can offer private credit, for example. They can do derivatives trading, and Ripple is an example of one issuer like that. They say they're seeking to become a bank. Well, they already look like a bank in certain ways, but a very risky bank and not backed by anything. So we, on this side, in the European Union, there has been considerable caution. But MiCAR is basically consumer and investor protection. And the concern for financial stability is recent, not really much in MiCAR. It's been led by the European Central Bank and the European Systemic Risk Board. Concerns, and we'll come back to this, concerns about run risk, concerns about instability, concerns about the communication of that instability to the rest of the financial system. And also some degree of concern about the role of US dollar stable coins in cross-border activities. So I'll stop there for the moment. We'll come back, I think, to some of the key issues that we present in our report, in particular what we call multi-issuer stablecoins.
Indeed, Richard. Thank you very much. And I think it's a perfect inch for Maria. So Thorsten and Richard both mentioned the perception of risk that could be produced by the diffusion of US stablecoins in the European Union market, right? And Richard was already mentioning that MiCAR, when it was designed, was not, let's say, including financial stability concern because it was more focused on customer protection. So my question for you, Maria, is, so looking at both use cases and regulatory developments, do you think US denominated stablecoin could achieve significant scale in foreign markets? What about in the European Union? Could European Union consumers be attracted to use such instruments?
Okay, so first of all, thanks very much. It's lovely to see everybody, and it's a very nice topic to discuss. Nico, you and I, we talk about this all the time, so I think it's also interesting to see how it evolved. Thorsten talked about the Libra. Remember very much the age of the Libra and how the European Union completely killed it actually with the regulation And actually, out of that, MiCA came, and it was very much, as Richard said, a consumer protection issue, which was very much the threat perceived at the time of Facebook taking over a very established clientele and then giving them access to finance. Yeah, despite the motives that Facebook had put forward, there was I remember the concerns being tremendous that this is going to be systemic from day one. And how do we deal with that? Yeah. So that fear really motivated the thinking, and also afterwards, the digital euro. Well, we know the digital euro has moved in different directions now, and it's advancing. But on the user case, I mean, I want to go back and sort of think about, as I always do, Nico, when we talk about this, I was like, well, the whys. What would be the use case here, right? And I mean, if I want to add one more thing on the way that both Thorsten and Richard talked about, is the fact that you issue a currency, so it's backed by a dollar, but you issue a currency. So there is, for non-dollar-based consumers or agencies, there are two types of risks here when you think about using those coins. One is the dollar, the exchange rate risk, yeah, and the other one is the issuance risk, yeah, because the Trump coin or the Melania coin might actually, tumble for reasons that one could think about, many reasons. What happens then? We've had many failures of DeFi companies in the past 5 to 6 years. The question is, this is not a model that has been tested and for us to truly understand it. So there is counterparty risk. So there are two risks that you have to take into consideration if you are, let's say, a euro-based person that considers this. Yeah. But the use of this could be two things, in my view. Either you're interested in having an asset. You want to hold it because you're like an investor, or it could be a consumer, but you're holding it as a value as you're holding value like any other asset, or you want to use it for payments. And let's see the proposition here of what you want to do. If you want to hold a dollar asset, go ahead. You can hold dollar assets in any form that we see today. So this is just another one. And then you have to take a view about the issuance risk. Do you trust that this coin will deliver or will maintain the value, and indeed will honor the backing up of the asset, which is the dollar and indeed the treasuries, as Richard said, yeah? Do you trust that if something goes bad, you will get that back? Yeah. But if you're holding an asset that is not giving yield, as Richard emphasized, then why are you holding it? Why don't you just hold cash? Yeah, buy dollars and hold cash, right? So that's the kind of thinking that you need to do when you're thinking as an investor, should I hold this asset? Yeah. So that, in my view, doesn't sound very interesting. And in any sense, it doesn't sound very different to other things that exist. And you have to understand why is it that you are now going for this new asset. But on the payment side, I think there is an issue. And here, if you allow me, I want to take 1 minute to explain that financial flows in the past, let's say 25 years, have really increased globally. But the infrastructure to support, and by that I mean the payment infrastructure to support the flows of these financial funds, has not increased in modernity. It has still remained a rather laborious issue. It hasn't really matched, the flows and the infrastructure haven't really matched each other, which means two things. It means that payments are costly, cross-border payments across the world, and they take a long time. So they are in grave need of modernization. And here I think Bitcoin, the ledger, all this technology offers a very interesting, innovative solutions. Bitcoin had the problem of not being stable. So now stablecoin comes in and say, no, this is stable. So to the extent that you want to use that as a payment method, this is quite interesting. And actually we hear it from banks that their clients are asking for faster payment methods cross-border, yeah? So let's come into the euro area now, right? Which is your second part of the question. If you are a consumer living in Belgium like I do, and on a Sunday you want to go to the bakery and buy croissants, would you ever consider using a dollar-backed stablecoin as a payment system? The answer is no. Yeah, why would you take an exchange rate risk, and why would you take a counterparty risk when you have so many other payment methods? And soon enough, we also have the digital euro. Yeah, so no. I don't think so. But when it comes to cross-border, and by that I mean outside the EU or even inside the EU, I mean, inside the EU, you have to decide, do you really want an exchange rate risk to transfer from an Italian bank to a German bank? The answer is probably no. Why would you want to bear an exchange rate risk, let alone a counterparty risk? But when it comes to cross-border, given the current infrastructure, or the infrastructure is being developed, because let's just face it, that infrastructure is also being modernized, I think stablecoins offer one solution that you can actually use it to really modernize payments and make fast payments. So I can really see both EU big financial institutions that do transactions cross-border, as well as others outside the euro area that may think of like, what is a good solution in terms of making cross-border payments, and stablecoins could be one of them. It's an interesting, I have a personal experience of a friend who is trading with Africa, who was telling me that those people in Africa, they price in euros so that they have stability of income, but they don't have access to dollars or euros to pay him. And he was telling me that they use Bitcoin at time T, meaning that they buy and sell Bitcoins immediately so that they don't bear exchange rate risk. But the facility of payment as a result of having a technology that is so advanced is really quite innovative. Now bring stable coins that actually reduce also the instability of the Bitcoin, and I can really see a business case for cross-border payments.
Thank you, Maria. Fantastic. So we just finished the first round of basic, question and answer. So I would like really to encourage our participants to input questions they might have in the box chat, because I'm gonna keep monitoring and we'll try to integrate. And then we also have a final, let's say 15 minutes for open questions. So if you're hearing something that is interesting, if you want to learn more about specific aspect of the discussion, please, let's try to make this section as interactive as possible. I know it's online, so it's passive by definition, but let's try to be active and engaging. So, Thorsten, going back to you, and also connecting what Maria was saying on use cases, right? So, and also taking into account the report that we mentioned published by the ECRB. Do you think stable coins are creating new channels of systemic risk? And in case, which are the key risks that you see emerging, and how are they different from those we know already in traditional banking?
Thanks. So the first thing actually I want to say before I come to stability. So I don't think anybody who listens should take anything that I think I can speak also on behalf of Richard and Maria here as being hostile to innovation. I think financial innovation is incredibly important. And you could see stable coins as financial innovation, and Maria just gave a use case for that. And I've seen it actually even before I remember actually that was even before the pandemic, kind of blockchain based payments, cross-border payment systems in Africa. Actually, I think it was either EcoBank or Standard Bank, basically to avoid having to go through the US dollar system, which of course is costly. Number two, as you might know, not everybody likes to go through the US dollar payment system for all kind of reasons. So I think there is definitely a use case there. However, with any financial innovation, or not with every, but with many financial innovations comes stability risks. And I think that's what we are focusing on today. And so the question that you just asked was, is this time different? And yes, so there are some risks you could argue are kind of new, and they come with the kind of the digital version of, or the digital aspect of stablecoins. Obviously, cybersecurity, the risk of theft, the risk of hacking. I mean, we've seen it also with with bitcoins being lost or wallets being hacked and so on. You have the custody risks, and of course, you have money laundering and evasion of sanctions. And that is certainly, well, it's a political risk, you could say, geopolitical risks. But again, stable coins can be used for that, and we've seen it also with some ruble-based stable coins. But what I want to focus more on is the financial risks. And here it is a bit like if we apply the duck test, if it walks like a duck, if it quacks like a duck, it might be a duck. Stable coins remind me a lot of money market funds. Now they're not exactly the same, because money market funds, you hold a share of the fund, and stable coins, you have a claim on the stable coin. So it's somewhat different, but the underlying balance sheet structure is somewhat similar. You have on the one hand of the balance sheet kind of the promise of one-to-one convertibility. On the other side, you have assets, safe assets, very safe assets, bank deposits, government bonds, but especially government bonds, as we know, and I mean, I think Richard being in London, he can tell us about 2022. They can also vary in the price quite a lot. So there's the risk of what in 2008 we called breaking the buck, when the money market funds could not redeem shares or at par. And ultimately, that was one important aspect of the global financial crisis. And similarly now, you could have the depacking of a stablecoin, meaning it goes away from the promised value being tied to, for example, the US dollar. Now, is that a theoretical a possibility? No, it's not. And we've seen it in a couple of cases already. We've seen it in with USDT in October 2018 and the USDC circle in March 23, which was actually linked to the banking sector, to the banking turmoil and the failure of SVB, because Circle did have accounts, deposits with SVB, and of course that was to back the stablecoin, the SDC, and of course that then raised, of course, problems for maintaining the parity, and ultimately they also went away. So there is this risk of depegging, there is the risk of volatility, and basically people not being able to redeem their stable coins. There can also, again, it can be purely technical. I think there was recently, and I forgot now exactly who it was, there was, I think it was Binance, where there was so much demand for redeeming or for exchanging stable coins that ultimately they had to stop trading, and that turned into an issue for the value of the underlying stable coins. But this you could say, well, it's just the stable coins itself, right? But of course, through the balance sheet structure, meaning through on the asset side, meaning through the deposit holdings and through the treasury holdings, there is of course an impact on the rest of the financial system, meaning large bank deposit withdrawals, meaning large sales of government bonds, which can have a price impact. And that's ultimately where the link comes in with the rest of the financial system. And I think that's why we can say that, yes, indeed, there could be these spillover effects, which ultimately then make the depegging of a stable coin turning into a systemic risk. Now, this has, I wouldn't say has not materialized yet, just simply because they're not big enough yet, but it is certainly a risk on the horizon. So I would not exclude it for the future. And I think it's something very carefully to be watched.
Thank you, Thorsten. We are getting a lot of questions, which I love it. So I'm gonna try to address some of them if they're relevant to the answer of the speakers. Otherwise, the other one will be addressed at the end of the Q&A. So maybe just to address one that is relevant to financial stability risk, Thorsten. A participant is asking if in the US they have a concern about outflow from commercial banks deposit to let's say stable coins. Do you think that this is an issue that the US administration is taking into account? Are they concerned about it? Or I don't know if also Richard, Maria, in case you would like to address the question.
Okay, so the first thing to know is that, of course, there is always, unlike in Europe, the money market funds are much more prominent in the US, and there is typically a flow back and forth between money market funds and US dollar. Now, not every single depositor is going to try to arbitrage the returns on that, but you see with the interest rate cycles, flows going back and forth, which is, of course, more the cyclical move. But yes, there could be partly a move of deposits of bank deposits into stable coins. That's certainly true, especially if there's different regulation. Although I think the hope of the US administration is to attract actually more money from abroad. So not necessarily money that depositors changing, US bank depositors changing into stable coins, but more attracting additional funds from abroad.
Thank you, Thorsten. So I see some question related to MiCAR and the multi-issuance issue. So here is it's great to give the floor to Richard. So Richard, you mentioned before MiCAR, so the regulation promoted by the European Union. And my question is, so on the multi-issuance models, do you think there is some risk that are not properly addressed in the regulation? Which are these risks, and how the European Union, if you know, the Commission, so the GFISMA as well, DCB, are discussing, if they are discussing on how to potentially revise or not revise the MiCAR regulatory framework?
Let me first pick up a couple of the points that have been raised previously, and then I'll come on to the multi-issuance stable coins. And make it clear, Thorsten said, you know, we're not hostile to financial innovation. Of course we're not. And on the other hand, there is always what we call the fear of missing out, FOMO, right? And FOMO is driving some, at least, of the policies, or at least the views of some policymakers, and the reactions of market participants to policy. So I think we have to be a bit concerned about that, because FOMO can lead to a race to the bottom. If you want to have, you want to be a big crypto hub, what do? You try to attract business in ways that may not be very good. And even under MiCAR, there is plenty of room for national authorities to have flexibility, shall we say, in dealing with stablecoin issuers. And that is something we have seen so far. And I'll come back to that in talking about multi-issuance stablecoins. And then the point that Thorsten makes about the balance sheet structure, similar to money market funds. That's absolutely right. And of course, we know there were major runs on money market funds, both in 2008 and in 2020. And the central banks had to step in. The central banks, and in particular the ECB, are concerned about the stablecoin developments, partly because they are worried that if there were a run, if there were a disruption that might actually affect the traditional financial system, go outside the crypto world, they'd have to step in, and they don't want that. So I think we have to bear that in mind. Now, multi-issuer stablecoins, it is an issue we made some substantial observations about this in our report, and the president of the European Central Bank has expressed her concern about this. I wrote an op-ed in the FT about this. The point is here that you have an issuer in the United States, in particular Circle, and they are issuing a coin, USDC, that they are also issuing or seeking to issue, and so far they have provisional authority to do so, coming from the French regulators. That's the point, partly about the decentralization in MiCAR of enforcement. They have the possibility of issuing the same coin in Europe. Now, the thing is that each coin, the US version and the European version, would be backed by reserves, okay? But the European coin is not likely to be anywhere near as big in the sense of market cap, in the sense of the amounts behind it, the needed reserves, anywhere near as big as the US one. But suppose there's a run on the US stablecoin, okay? Holders would be entitled to redeem from the European stablecoin, but the European stablecoin reserves would be nowhere near adequate to deal with a run coming from holders of the US stablecoin. As I say, they would be entitled, because these things are fungible, as we say, the US holders of the US coin would be entitled to ask for redemption. And what's more, we ban redemption fees. MiCAR bans redemption fees. Genius Act does not. Okay, so there's indeed an incentive to look to redeem, if you are concerned about the stability of this USDC, to redeem from the European side. But the Europeans won't have the reserves to deal with that. And that's what we're concerned about. That's what we're concerned about. And the European Systemic Risk Board has, in fact, issued a recommendation, which is the strongest thing that it can do. It's a comply or explain kind of matter. Issued a recommendation to the European Commission that they ban these multi-issuance stablecoins in Europe. Now, and if they do not accept that, then the ESRB has proposed a whole set of safeguarding measures that the Commission could take. Now, that then leads us to the question of, could MiCAR be revised? Up until very, very recently, maybe last week, the answer was, oh, no, we can't. We're not going to go into this. It's fixed in stone. It was a long negotiation process, and we're not going to revisit that for a couple of years at least. But guess what? All of a sudden, this is in play, and along with a number of other possible regulatory innovations. So it is quite, it is now not excluded that MiCAR be revisited. And this would, of course, be one of the significant issues that any revision of MiCAR would have to take on board.
Thank you, Richard. Very, very clear. We had a few questions on the multi-issuer topic, but I think you addressed them quite extensively. So maybe looking at the question, I think something interesting came out. So if you think there are some criteria, upon which criteria would you start considering a stable coin a threat to financial stability?
You want me to start?
Please.
Financial stability, the threats of runs and so forth, and indeed the past difficulties in sovereign debt markets have been part of my research for a long time. So I'm very conscious of all this, and there is significant run risk. Stablecoins. The title of this webinar is bracket and bracket stablecoins. They are volatile, first of all, by the way. They are not, the peg is not uniquely 1 to 1 to 1 to 1, etc. You can see variation. It's small. It is typically arbitraged away, but there are cases in which the peg is have been cases in which, and I think Thorsten mentioned it, the peg has been broken. There was a very recent one associated with the disruptions in Binance. You see, to get a retail investor can't just go to the issuer, whether it be Tether, whether it be Circle, and say, I want my money, please. I want my fiat back in exchange for my tokens. They have to go through a platform. And the platform then is effectively run for and by institutional investors. So institutional investors have to be willing to redeem, in effect, the stablecoins. But suppose that they don't want to. Suppose that they've got other things to do. Suppose that they're concerned about the possible instability of this instrument, and say, no, I'm not going to play. Then what happens to the retail investor? Nowhere to turn. Okay, that is compounded by something that is fairly recent, but is, I think, a potential major source of instability in this area, which we did not treat in our report because it is so recent, and that is the expansion of highly leveraged trading in these markets, and that there's a particular Aave is one of the markets on which this is happening, and the degree of leverage. I was unaware of this myself until very recently. The degree of leverage that you can exert in these trades is extraordinary. So, and we know what that can lead to. Okay, so it's not just the risk of breaking a peg of a run. Okay, which is something that we're familiar with. Exchange rates break their pegs. There's a run, etc. We make a big point of this in our report. There is run risk. Okay, and the reserves, by the way, the reserves are not so necessarily so good as you might think. Indeed, the European Commission has made a big error, and I hope they will retract it, in suggesting that money market fund shares can be part of the reserves backing a stablecoin. you can't liquidate your money market holding just like that overnight, right? And so the idea that money market fund shares should be reserves against the stablecoin is just not very sensible.
Thank
So,
you.
you know, we've got real problems there. Thorsten, I think, clearly wants to intervene. Go ahead, Thorsten.
All right, just to make 2 points here, to follow up on what Richard just said. I think the issue is that these stablecoins are being treated as if they were safe assets, and that's why they're being used in this leverage, which of course, again, we know it's not the case. And number two, I mean, since Nico, you asked me earlier about the systemic stability implications. I mean, this makes it, of course, even worse because now you have leveraged exposures, and that's so all of these systemic kind of risks elements that I mentioned earlier become even worse if stablecoins are being used to build up these additional leverage.
Okay, fantastic. Thank you very much. So now shifting to the global and geopolitical landscape, I would like to give the floor to Maria. And Maria, my question for you is again on the role of the international dollar, because I think there are some questions also in the sense, will US denominated stable coins threaten the US global role, or they might actually undermining it?
Yeah, okay. So maybe if you allow me, Nico, I want to maybe also add to the previous conversation, because I think that's really fascinating. The question on at what threshold do you consider things dangerous or not is not an easy question to answer. The answer is not 42. Yeah, I mean, and right, I mean, and not only is it easy to answer, but it's also not necessarily constant. Yeah, I mean, that value might be different. I think from a policy perspective, the regulators worry about systemicness, and the digital nature of this, and the fact that it is the dollar, and the fact that it is a potential for payment really has elements that should raise alarm bells in terms of the possibility of being systemic, irrespective of what that threshold is and whether we know it or not, right? I think it's correct that, you know, the regulators worry about risks before they happen, right? I mean, and that stablecoins have all the elements, as both Thorsten and Richard explained, of becoming systemically relevant and actually detrimental, yeah? Now, on the dollar, right? It's interesting, Thorsten, you talked about safe asset. I mean, please name one safe asset. It would be, you know, cash.
Well,
Cash.
yes. Well, fiat, yes, exactly. Fiat back.
Yeah. So, but that's not really where the innovation is. And by the way, I would second the views that we're all in favor of innovation. So, I mean, but innovation needs to be backed up. What, in my view, makes good finance, which is regulation, reserves, and legal recourse. Yeah, and you know, regulation is what we're talking about. Some good, some bad, needs to be revised. Reverse, we have them, but you know, do we really? And are we sure we're going to get them back? Okay, and then legal recourse, who accounts from whose faults? And I think the way that Richard described this idea of where you can redeem those assets is absolutely crucial. Yeah, and this is where a regulatory divergence can actually be a game changer, and why it's crucial that these types of issues are regulated at the global level so that we kind of understand and distribute risks appropriately. Yeah. So then now on the geopolitical things, right? I mean, again, I want to go to the use case, back to the use case, because this is where we understand what this can be useful for. And there's many questions that are coming out about developed world or you know, the digital euro. What should we hold? Again, the business case is: do I hold it as an asset? I don't think it's interesting as an asset, actually. Yeah? There's so many other things you could do, but you know, go ahead, hold it as an asset, and then bear the risks accordingly. But on the payment side, I think there is, because of the innovative part, there is some use case for this, right? And let's understand for whom this use case. European exporters via banks that pay mostly in dollars for their trade, they may actually follow the following calculus. The cost of these stable coins versus the risks, versus, on the other hand, going through a rather laborious system of payments that cost me a lot of time and money. Yeah, the interbanking system. Which one is better? I can make that calculus and decide accordingly. So there is a business case here, and I think innovation actually adds here. But then let's go to the rest of the world. Let's go to the developing world. Will the developing world have equal access to stable coins, dollar-backed stable coins? That's the question to ask. My sense is that there will not be an easy access for the same reasons that some of the developing world does not have access to dollars or euros, at least not as easy as we do. They won't necessarily have easier access to stablecoins, maybe on the margins, but it will not be quite so easy, I think, to have access to dollar-backed stablecoins, because exactly those assets need to be paid by dollars and backed by dollars. But if you can pay in dollars, well, why don't you just pay in dollars? Why do you need the stablecoin, right? I think on the margin, you could make a difference there on the global usage of these countries. But the most important part, and this comes now to Nicola's point on geoeconomics, is do you really want it? Remember, if you're holding stable coins, if you were a Russian, in the 2000s, you were a Russian exporter, and you were holding stable coins, on the day of sanctions, you will have no access to them anymore. Yeah. So there is this argument, since they are dollar backed, they don't remove you from the dollar infrastructure, the dollar architecture. So it doesn't solve the geopolitical element, which, by the way, is one that is biting the most right now. This is the issue. So, I think we need to find ways of the technology being useful and giving access to the developing world. But whether stable coins, dollar-backed stable coins are the answer, I doubt it.
Can I come in?
Please.
Yeah, the use case, Maria has made a convincing argument that there might be a use case here in cross-border payments. But remember, the banks are not going to sit around, okay, and just say, oh, let them eat our lunch. Excuse me? The banks, I think, are likely to respond to all this. They already have, to some extent, responded.
Indeed.
The charges that I incur for paying somebody in Italy now are way lower than they used to be.
Indeed.
Okay.
Exactly.
And you might say, really, they just reflect what you ought to be paying for AML and KYC.
Yeah.
No, it's not that much, and compliance is not, it's not free in terms of resources. So that's, I think, important. And as I say, there will be further pressure on the banks and on the credit card companies too, by the way, to lower their fees. But the banks, how can they respond? They can tokenize deposits. And that's what I think is likely to be the death, ultimately, of stablecoins, is that the banks are going to tokenize deposits and issue them. Now, that may, and this is something that has to be looked at very carefully. You don't want to go back to the Wild West of banking that you saw in the 19th century in the United States, when currencies were issued by many different banks, and this was not a recipe for financial stability. So there has to be some way of guarantee what Hyun Shin, for example, has called the singleness of money. Okay, that money, there are two different kinds of money, right? There's one kind of money, it's fiat money. Okay, and sure, it can be dollars or euros or whatever, but we have exchange rates between them, and these monies are legal tender. Okay, and you pay your taxes in those monies, not in stablecoins. So I think these are big issues going forward, but don't expect the banks just to roll over and play dead. They won't. Not J.P. Morgan, nor Morgan Stanley, nor even our own Deutsche Bank and Unicredit and BNP Paribas and HSBC. They're not going to sit around.
No, I actually agree with you, Richard, and that's why I said there is a calculus to be made here. The calculus is the cost of stable coins versus the cost of current banking. And all of this evolves, right? So this is not, I tend to agree with you in terms of the direction of travel. Where is the end game here? Where are we going to see as the end game? Is it going to be a market for stable coins that is kind of, exuberant? I don't think so, because the business case actually is not as interesting as that, right? Yeah. I mean, in the course of Europe, we have the digital euro now, which is the answer to all of this. So, why would you want to sort of take all these risks on you when you pay in dollars? And if the ECB also allows for the digital euro to be held by outsiders, then you really kill the case for innovative cross-border payments because you have one in-house. So, yeah.
But that brings us back to the original point that I also made, and that came out in this report that Richard co-authored, that most of stablecoin transactions are not for cross-border payments. They are the linkage between the on-off ramp between crypto and between traditional finance. And I think that's where the use case currently is, and that's where you could see kind of a bubble. But this bubble is directly related to the crypto bubble, which of course is again also fostered by the same administration that is trying to push for stablecoins. So I think it's again linked with each other.
That's
By
right.
the way, the same administration, the same country, whose U.S. Treasuries market is, I mean, USTs are, of course, the major backing, right, for stable. U.S. Treasuries market is not exactly the healthiest market in the world right now. There hasn't been, the plumbing of that market needs a lot of work, okay? And everybody's conscious of this and they're working on it, but we've seen a number of instances in which the UST market has seized up, right? And you can't, you can't say that stablecoins are stable because they're backed by U.S. Treasuries. Well, maybe.
Period. Bit spurious.
Okay, thank you, because I think this exchange is what we like here, so that we can enrich our participants with comments and discussion. I just want to bring back to Maria to build on your answer and to also address a few questions that were raised in the chat. So as you mentioned, some of the questions were directed to the use case for the global south and also the risk that US denominated stablecoins could bring to the global south. But also another question is about fragmentation, and I know that this is one of the topic at your heart at the current moment. So fragmentation of let's say the global payment system, and here in addition to a reflection on stable coins, so if not interpol stable coins could bring fragmentation in cross-border payments, I also would like to bring the discussion also in terms of wholesale CBDC development. So we know that, for example, at a global level, we have a few projects that have been run or are run by the BIS, so Project Agora with the major Western central banks, as well as Bridge that was formerly, let's say, launched by the BIS. We know that the BIS, exit the project and now is sort of led by the People's Central Bank of China. So do you think fragmentation is an issue or a future issue?
Yes, I definitely, and I definitely think it is. Just the 2 parts of the question. One is about the dollarization of the global south. I mean, dollarization in the sense of the use of the dollar. It's not the dollarization per se, right? And I think it was Thorsten who started by saying that there are things that happen in the US that are reducing the appeal of the dollar. Could the stable coin be a way of reviving the appeal of the dollar, right? And at the margin, it might be a good way of accessing dollars, but I don't think this is a game changer. And to the extent that the dollar itself is becoming less interesting, stable coins based in dollars should also become less interesting. So I just don't think that's what I mean by spurious. The whole is self-reinforcing. Yeah. Now on the fragmentation, I definitely think that is the fragmentation, and it's a geopolitical issue. Yeah. I mean, I think. Let's just start by the currencies. I think there are good reasons in the sense that they're happening, why countries around the world don't want to have to rely on the dollar. They want to find other ways of making payments and actually depend what actually Fishman called as choke points. Yeah, the dollar is a choke point. It's actually possibly the biggest choke point that the US has in its hands to actually try and enforce behavior. And there are many countries, and China being the most obvious one, but who is actually reducing the reserves on dollars and reducing the exposure on US Treasury continuously. And others, we've seen it with the Latin Americans. I mean, do we really want, and by the way, it's also true for us. We have 60% of our payment system is relied on US firms, not on US dollars, but on US provided services. Is this an uncomfortable dependency? We have to ask that question because relations aren't what they ought to be. And the direction of travel is also not the right one. So fragmentation is at the core of this. I think the system will evolve into a much more multipolar system where the dollar will lose some of its attraction, but not much because there isn't really an alternative. But to the extent that people want to make payments and use infrastructure for settlements, which is one of the big reasons why we use dollars today, it's not just the dollar is a good currency. I think there will be replacements, and the bridges is one, and it will be centered in China. African countries might find other tokenized asset type of payments that they can do and accept for each other. So yeah, I think there is space for the euro to do a little bit more, but it cannot really replace the dollar. And the question is, what is third? So I actually see it as a, if you like, a three-prong approach where the dollar loses a little bit, the euro improves a little bit, and then there is other stuff. Just for those who do not want to be involved with us or the US, who find alternatives way. And innovation, technology will be the answer there. There is now means to provide infrastructure for settlement that doesn't have to be based in New York.
Thank you very much, Maria. So I know that Thorsten would like to sense also on this issue. So I will leave the floor to Thorsten, and then the final floor to Richard to close the webinar, as we are just already almost 2 o'clock. Thorsten, please.
Thank you. So I actually want to come back also to this issue of the stable coins and the US dollar, the value of the US dollar, actually the exchange rate. So I think, because I saw a couple of comments there in the Q&A box, and I think people might give too much credit to the current US administration when it comes to balance of policy and balance of payment analysis and policy design. Because of course, you want to have cheaper exports, you want to export more, you want to have a weaker US dollar. On the other hand, of course, if you want to fund your widening deficit and higher debt, you need more US dollar. And of course, we know that current account and financial account are kind of the two sides of the same coin. So you have more capital inflows, you have a higher current account deficit, and the other way around. So similarly, actually, with all of these FDI or the FDI promises that Mr. Trump has been getting over the last year or so. So I think that is it's just not. I don't think there's a consistent policy here. So I think yes. If, and again, Maria pointed out that is a big if, stablecoins lead to more inflow into the US dollar, that would actually push up the price. Yes, it would ultimately lead to appreciation of the US dollar. Again, how big that would be, I somewhat doubt it as well, but it goes against the other policies to have a weaker US dollar. But again, there is no consistency, I would argue.
Thank you very much, Thorsten. Richard, the last floor is for you. Some wise final words to close this fantastic session.
Fragmentation is a big issue that impacts on this topic we've been discussing as well as others. There's a new CEPR report, Geneva report, that covers some of those issues. Just came out yesterday, day before, just a few days ago, whatever, which I recommend to you all. The need here for international cooperation is really very, very considerable. And the proper locus would be the Financial Stability Board. And the trouble is that the FSB has issued a set of recommendations and reports and so forth in this field, the area that we've been talking about, and the US has more or less ignored them. And I think that's what we're dealing with right now. We've got a real problem in issues that require, whether they be stablecoins or more global imbalances that Thorsten was referring to in a way. We are not seeing a particular interest to cooperate from the other side of the Atlantic. And until that changes, we're going to have trouble in this area, the stablecoin area, as well as quite a number of other areas that are relevant to financial stability, shall we say, as well as bigger issues than that. So I think that's where we are. International. What's clear and what's come out, I think, of our discussions is that international cooperation really these instruments are not confined and designed not to be confined to national borders. But that means you need some degree of international coordination, cooperation to regulate them. And we are not seeing that.
Fantastic. On these very, let's say, wise final words, I would like to thank our great speakers, so Richard, Thorsten, and Maria. I think it was a very fruitful discussion, a lot of insights, and stay tuned because at FBF, as you know, we will keep working on these on this very hot and sexy topic. Always, stay tuned also on the training offered provided by the Florence School of Banking and Finance on our website. And I would like to also thank all my colleagues behind the scene that made this webinar possible. Have a lovely afternoon. Stay tuned and hope to be in touch. Thank you very much, all.
Thank you.
Thank you.
Thanks.
Thank you.
Bye.